Investment Podcast. Your host, Robert Frazier and Corby Code. Welcome back. We're at episode 4, and this has been a lot of fun.
Yeah.
I think we're going to do more of this.
Yeah, we should do this every day.
Well, okay, we'll try.
We can do it twice a day if you prefer.
Oh, that's what I was hoping for.
Yes.
I was hoping for more. You know me. If I twiddle my thumbs, I just get idle hands.
Yeah.
Devil's Workshop.
That's right. Yeah, you're the type of guy that just sits around a lot and waits for somebody to give him something.
That's what people tell me. Alyssa's always like, Robert, I'm so bored. Please give me more projects. All right. Today we're talking about analyzing single-family home rentals. Mm-hmm. So, Corby, give us all the secrets, man. We're tired of you holding out. We want to learn more from you about how you do it. I know that this is your favorite thing to talk about.
I do like talking about this because it's, in my opinion, it's so much simpler than people think. People love to complicate this.
I agree. Yeah.
The simplest way to put it is everyone has a different set of resources and a different risk tolerance. Uh-huh. And you need to figure out what that is. And you look at a property, and whoever you're working with, if you're working with us, that's cool, but we can help you come up with what the income of that property is going to look like and how much it's going to cost you to hold it. And if the difference between those two things is acceptable to you, it's probably a good deal for you. If it's not, then it isn't.
Okay. Well, I think investors get a little hung up at the beginning because they're not you and me that mm-hmm. have access to data about how much they're going to rent it for.
Sure.
Or they don't know how much it's going to cost to fix it up, or they don't know how much their financing is going to cost. Mm-hmm. Walk through how people find the numbers so that they can make good decisions. Let's start there.
Okay, great. There's a lot of really simple ways to figure out what your financing costs are going to look like. And obviously, first things first, you're going to want to talk to a lender.
Yeah.
And figure out how much you can borrow and get an idea of where rates are and that sort of thing. But there's a million mortgage calculators online. And honestly, that's where I start when I'm looking at a property.
Just for round numbers.
Yeah, I jump on there and you can plug in what you think your interest rate will be like, how much you're planning on putting down, what you think your purchase price will look like, and your escrow, which means your taxes and insurance that go into that payment.
And a lot of times those websites even have an average mortgage cost of Idaho today sort of thing on them. You can take that number, at least use it, as a round number.
Sure. And if you're new to this, you also should keep in mind that if you're buying a home strictly as an investment, you're going to pay a higher purchase price or a higher interest rate. Yes, absolutely.
Yep. And you're going to need more down.
Yeah.
Both those things.
In most cases. Yeah.
Yeah.
So that's a good place to start as a mortgage calculator. I personally like the one on bankrate.com because it's really simple. And then if you really want to nerd out, they have a bunch of amortization schedules that you can play around with numbers that it can be really fun. So beyond that,
fun for real estate nerds.
That's right. That's right. Fun for real estate nerds. So beyond that, every market is different. And so if you're investing in Idaho, there are different utilities that tenants expect to pay and that they expect their landlord to pay. And that might be different in Colorado or in Louisiana. And so you'll want to get
insurance rates are very different.
Absolutely. If you're talking to somebody it's funny. There's a landlord-friendly state in the Southeast, Florida, that prices are reasonable and vacancy is low. There's tons of short-term rental opportunities there, but insurance can cost you $10,000 a year.
Seriously.
Yeah.
And Texas is similar.
Yeah.
Very high insurance and tax rates in Texas. Yeah.
So understanding the insurance and the taxes can make a huge difference, because if you're just running numbers on a mortgage calculator based on your purchase price, depending on where you're investing, that can be a small piece of the pie.
Yeah. You can look up taxes on, a lot of times the county assessor site will list out what your taxes will be.
Yep.
And there's two types of taxes. There's one that's an owner occupied tax, and it may look low because there's somebody living in it who is an owner on the property. In Idaho, we have a $250,000 exemption for living in your primary residence I think it's called the homestead.
Yeah. It's 125.
Oh, it's 125.
Yeah.
Sorry. I was hopeful that Idaho was going to fix it. So it's 125, which means that it lowers your rate from, maybe 3,000 down to 2,500, a year sort of thing.
I usually give people a round number that you're essentially going to pay about $100 more in taxes if it's an investment property than if it were an owner occupied property.
Yeah, that sounds about right. Yeah.
So understanding what those extra expenses will be is pretty important. And then as far as the income goes, it's funny. A lot of people will jump onto Zillow,
Get that Zestimate, baby.
or Craigslist or Facebook Marketplace to see what things are renting for in the area. In Idaho, property management is not regulated, and so anyone can be a property manager and rent a property out and advertise it for rent. So one of the challenges there is just because somebody's asking a certain number for rent does not mean that is what that property can actually
that they're
bring
getting
in.
it.
Absolutely. And so we see that a lot. We'll have clients that will come to us and say, "Hey, I saw this rental down the road from me on Zillow, and we're renting their property out, or we have it listed for $2,400." And they say, "This person's renting it out for $3,000." And so we'll look at the Zillow ad,
offering it for $3,000,
and they're offering it for $3,000, and it's been available for 7 months. Mm-hmm. And so obviously there's a difference in those two rates, but if you take the 7 months they've been waiting for that extra $600, that those theoretical gains are wasted very quickly.
Well, we've had times here in the Valley in 21, even 22, where vacancy was dropping down in the low single digits.
Yep. And
you could get a premium because there was so little available on the market.
Yep.
As soon as there's a little bit of flex though in the market,
mm-hmm.
that 2, 3, 4%, all of a sudden landlords are like, I'd rather have somebody in there than get the higher amount. So those numbers start to fall pretty quick.
Yeah, definitely. Yeah. And seasonality plays a big role in that as well.
Yeah.
If you're renting a property out between October and February, you're going to have a completely different experience than you would April through July.
Yeah, because most people move basically April to September is what, 70% of moves?
Yeah. Pretty easily.
It's a big number.
Yeah. I should go back and look at our turnovers, but I know the vast majority of the turnovers we have are between April and August.
You know, when we lived in Boston, they called it move-in weekend because there's like 600,000 college and graduate students in the Boston area. And all of them moved to Boston the same weekends. So it's like basically the middle 2 weeks of August. And they all, these are people who are, for the most part, especially graduate students, they're from like the Midwest or the East. And, they move to Boston to go to MIT or Harvard. And it's like a very big deal. And Starrow Drive is right along the Charles River. There's Memorial Drive's on the Cambridge side, and Starrow Drive is on the Boston side. And Starrow Drive is it's like a state highway, but it's pretty narrow. And it has it has an underpass on the roads that are crossing it. So Commonwealth, these big, like massive roads. And what we'd say is that every year somebody would get starrowed. And somebody getting starrowed is somebody from the Midwest who's driving a large U-Haul van that gets hung up on these underpasses.
Oh, jeez.
Every single year, like you just don't drive on Starrow Drive because somebody did it those 2 weekends. So almost everybody moves at the same time.
Yes.
Especially, and we are in a college town. I think that gets missed sometimes because there's between Boise State, CWI, NNU, College of Idaho, it's like 50 or 60,000 college students in the Treasure Valley, which is kind of crazy when you think about it. So you have to keep in mind if you're renting, the time frame at the end of the school year, the beginning of the school year are going to be really key times.
Yeah. And it's interesting. We get a lot of people reaching out to us that want to invest close to Boise State because they're aware of Boise State, either, because they're college football fans or whatever the case may be, but maybe they don't have a lot of experience with Boise. And I think speaking generally, Boise, even though there's a fairly large school here, it's not a traditional college town.
It's much more than when we went to college.
Yes.
But less than other places.
Definitely.
Yeah.
If you're looking at
it's not Ann Arbor with 60,000 students. Yeah.
Right. And there's an entire economy built around the income that a student has and that they provide. Boise is not that way. And so the reason I'm saying that is that although real estate that's around Boise State, by and large, is rented by students, it is not low-cost real estate.
No.
It's a whole different ballgame. It's actually very desirable real estate.
Downtown, desirable, walkable real estate.
Yeah, the campus for Boise State is, it actually butts up against two beautiful, huge parks
And the river.
And
Yep.
the river,
Yep.
and our downtown is just on the other side of that. And so it's very valuable real estate. Everything that people love about Boise is walkable from there.
Yep.
And in addition to that, the city is very generous with density and projects in that part of town as well. And so just the dirt is very expensive because there's high demand for high density.
Mm-hmm.
So in that regard, the real estate around the school, I wouldn't consider it. I guess what I'm saying is I discourage people from buying something with the intention of making it a student rental because it's not that type of market.
It's hard to cash flow unless you have a lot down. And I do know I've met several agents who have worked with people who want to find or buy a property down there, build it up, and then their kid's going to go to Boise State.
Yep.
And so they see it as a way to build a generational wealth for their child. I think that makes a lot of sense on some level.
Absolutely. That's a whole different ballgame. Actually, we've done several deals like that this year. I have one in escrow right now that's on Boise Avenue, which is right along where the university is. And it's a client that's buying it for that exact same intention. That's an advanced house hacking strategy, in my opinion.
Yeah.
It's a different thing than just buying something as a rental and thinking you're going to put students in there and that you're always going to have students cycling through. It's not the same thing.
It's very active management.
It's very active management. And if that's your intention, you're going to have higher vacancy, you're going to have higher turnover and probably higher turnover costs. And you can do significantly better in other parts of town here.
Yeah, Boise is allowing some alternative types of housing that looks more like dormitory style housing, or even they've cracked down a little bit on designs that are built like dormitory style, but are meant to be, duplexes, but they've got 9 suites inside.
Yep.
And they're just internal kind of suites. They're not external doors. I think those are great. If you can get one of those done, those can be really valuable because the student will pay, in the dorms, they're going to pay $800 a month, $1,000 a month for a shared room or a shared suite. And they'll pay that same thing and have a little more autonomy off campus, especially if it's close. You can turn an 8 or 9 suite, 3-story, townhome into something really valuable.
Yeah, that's true. But that is not a passive experience for an investor.
No, and parking's a nightmare.
Yeah. So I always like to talk about that because people talk a lot about rent by the room or these types of properties where you have individual suites and shared common spaces and how that can produce so much more income. And yes, it can produce so much more income. But as an investor or a landlord or a property manager, you also need to go into that with eyes wide open in that it's far from passive. It's a very active management strategy. And in a lot of cases, you become more of a referee for personal issues than an investor. And maybe that's a fair trade-off.
Maybe if you really like drama, maybe you're like a reality TV person.
Maybe. But I mean, if you know what you're getting into and you understand I'm going to be working a lot more, it's going to be very active and there's going to be a lot of intrapersonal issues that I'm going to have to understand how to deal with. And also separate topic that as a landlord, you shouldn't be dealing with interpersonal problems anyway, but it happens all the time.
You need to have some boundaries, but you get stuck.
Sucked in. It's not just that, but I'm getting off topic here, but we even deal with roommate issues a lot of times where we'll have 2 people that sign a lease together and one of them wants to move out for whatever reason, or they're having a disagreement and they can't stand to be in the same room anymore. And they come to us and ask for a solution. How do we deal with this problem? And not to be cruel, but that's not our job. Our job as landlords is not to make sure that you get along with your friend and figure out a way for you to get out of a contract.
Yep.
So we essentially just tell them, hey, good luck. Let us know how that goes.
Figure stuff out.
Figure something out. And
be an adult.
And that room by the rental by the room strategy is like that situation on steroids.
Yep.
And so you'll deal with a lot of that. And if you're going to get into that, you have to prepare yourself to throw that like my wife Heather would say, you throw that basketball back. You don't have to catch the basketball.
Yep. You're getting paid for the headache that comes with it.
Yep.
Because if you have individual units that have external doors that are not tied to common spaces.
Mm-hmm.
You get rid of a lot of that.
Yep.
But there's cost to it,
Mm-hmm.
and the city's not going to allow you to have it, which is that's a weird part of zoning codes, is that they'll allow you to rent by the room, but they won't allow multi-units.
Yeah.
It's a strange,
Yeah.
it's like, part of me feels like, you should get to do what you want with whatever square footage you have. So, okay. I know you get up early, so it's like 5 o'clock in the morning.
Yep.
And you open up your email and you've got, maybe a few different search emails that are coming through MLS or some of the, IDX feeds that you get.
Yep.
How are you analyzing? Like, what's your approach, like from a 30,000 foot view, and then how do you then get granular on each deal?
Well, this is, I think, where having an agent or somebody that really knows a market well comes into play, and where some of that value adds is I'm not going to pretend to know any other market or any other real estate.
It's hard to do from a distance.
Sure. I mean, if somebody, every once in a while, I'll get clients that'll say, hey, can you help me with something in Twin Falls or Pocatello, which they're a couple
Drivable.
hours. Yeah. But I tell them, no, I don't know those markets, and I'd be doing them a disservice. But that being said, I know this market really, really well. And the reason I'm saying that before I answer your question is, if a property pops up, 2/3 of the time, if a listing comes to me, I'll know where that property is just because of the street name. I've lived here my whole life. I've been all over this valley. If I see the street name, I'm going to know where it is. I can look at the square footage and the asking price, and I would say 75% of the time I can figure out if there's potential there within about 5 seconds.
Mm-hmm.
And so it's pretty easy for me to scroll through some of those and look at off the top of my head, like, that's not an opportunity, that's not an opportunity, but this one might work. So when I see those, I'll click on it, I'll look at the map, I'll look at the other properties that are surrounding it, get a feel for the condition of the property just by looking at the pictures. And one thing I like to do also is look at the listing agent and see how much experience that listing agent has, what their production looks like. Mm-hmm. There are some times that you can get a deal because you're dealing with an inexperienced agent who has made a mistake on a listing, and maybe they put in the wrong square footage. Mm-hmm. Maybe they put the property in the wrong category. Mm-hmm.
It's residential income, but it shows up as residential.
Absolutely. Yeah. I cannot tell you how many deals we've done on properties that are actually duplexes that they accidentally listed as single families, and those go under the radar sometimes for weeks because people are looking for single families, scroll through the pictures, and they think it looks like a weird place and they're not interested. People are looking for multifamilies, they're not looking at the single family listings, and so it kind of languishes in nowhere land for a while, and opportunities will rise. And when you're working with somebody experienced like our team, a lot of times you can see those abnormalities in listings really quickly. We actually just did a deal with a client a couple months ago that was a duplex. It was listed as a single family. The agent that had listed it had only done a couple deals before and made several mistakes in the listing, and it had been on the MLS for a couple weeks. And I shouldn't even say a couple weeks. I think it might have been longer than that. The sellers were getting nervous. They didn't know why it wasn't selling. It was pretty obvious to me why it wasn't selling, but it wasn't obvious to the sellers, and the listing agent didn't realize that they had made those mistakes. And we were able to go in and get them to accept a lower price on that property than they were asking because they were getting nervous. And we were able to get some credits during the inspection period to lower that price even further. And then the client who moved in there was able to utilize the highest and best use of that property and create some income. Mm-hmm. And the appraisal came in quite a bit above the price that he was paying for that property. And in addition to that, the zoning allowed for a third unit to be built on that property as well. And so those were excellent. Those are all things that we were able to see because of our experience with the market and understanding how those listings are supposed to be written that I think a lot of people might miss.
Excellent. Okay. So what do you think, like when you look at those estimates for rent, mm-hmm. Are you discounting them? Do you think that they're relatively close? How are you pricing out rent? You obviously do property management, so you guys have. Should you be talking to a property manager locally to really know what rent is, or is there a way to kind of handicap that?
Yeah, you should be talking to a property manager. A lot of the things that you see on Facebook Marketplace or on Zillow they're not priced correctly because it's somebody who's not in the market, and those might sit for a really long time. Those are asking prices. They're not actual prices.
The highest prices that you're hoping you're going to get for rent probably aren't real.
Right. Yeah, 100%. And you need to also balance everybody wants to get the highest rent that they can as an investor, and that's understandable. But the incremental gains that you might get for asking 5% more than market rate can be eaten up very quickly by vacancy. And so you need to balance what you think is reasonable. And so the conversations we have with our clients a lot of times are, here's what we think we can price this at to get someone in here within 2 weeks, get you a high quality tenant within 2 weeks. That's always kind of our goal. So once we
price
take something
and time are so intimately connected.
Absolutely.
There. Yeah.
So we think if we price it here, that within 2 weeks, we can have a high quality tenant placed and paying you rent. And that's kind of how we present it. Sometimes our tenants say, or our clients say, we want $200 more than that. And so we say, okay, if you want $200 more, then it might sit longer. And if it does, here's what we recommend as far as a pricing strategy. Let's go 2 weeks at your price. And if we don't get a certain number of inquiries or applications, then we're going to come down by this much, and we'll sit there for 2 weeks. And if that doesn't work, we'll come by this much, so that we're mitigating those losses based on their holding costs when the property is vacant. And we want our clients to get more. And to be completely frank, it's happened more than once where we've had a client say, no, I want $200 more, and we put it on the market, and within 2 days we have somebody paying $200 more. And so it happens.
Sent you a little
sometimes.
email saying, "See,
yeah,
I told you."
yeah. Well, it's an art, not a science, right?
Yeah.
It's whatever somebody's willing to pay. And so sometimes the right circumstances are there, and real estate's unique in that people rent and buy properties based on emotion, more so. Cost is part of it, of course.
Yeah.
But the reason I'm saying that is sometimes we can rent things at a premium because somebody's grandchildren live 3 houses away, or somebody's best friend lives next door, or it's really close to this person's work or their favorite restaurant, or whatever the case may be. Sometimes there's these anomalies.
It has nothing to do with the project or the price. It's just because of where it is.
Right. And you don't know when that's going to hit. And so maybe it's worth trying for that premium for a couple of days, but you need to be cognizant of how much it's costing you to hold that property if things aren't moving the way that you would like them to.
And then let's talk about equity growth, because there's kind of like the underwriting of, is this a place I want to own?
Yep.
How much is it going to cost me? How much rent am I going to get? But that's not the whole picture. The whole picture also includes this big picture, which is tax advantages and equity growth. So how do you do your calculations on those two pieces?
Well, historically, Boise has grown year over year on average right around 8% in equity. So that's appreciation.
S&P 500 numbers, right? There.
Yeah, I mean it's
but leveraged by
real
low
property.
down payments.
Yeah. So conservatively, I think something in the 5 to 8% is a pretty conservative estimate for year over year. Now, there are going to be years where we get 0 equity growth, and then there'll be years where we get 12%. So I'm talking on average year over year. And so personally, those are the numbers that I use, and that's what I tell my clients too. But it's a buyer beware situation too. If you're trying to get in and out of a property in a short period of time, you're increasing your risk profile significantly.
Trying to time the market is always more risky.
Absolutely.
Yeah.
It's no different than day trading stocks. Your risk profile is going to be significantly higher, and you're hoping for a quick gain
than just buying Apple stock and holding on to it long term.
Exactly. Yeah. Same thing. I mean, you can buy Apple stock and hold it for 50 years, or you could buy a mutual fund that performs at 7% year over year and it's very safe, or you can buy an individual stock that you can short GameStop, right?
Yep. if you've got the balls for it.
So anyway, to get back to your original question about equity growth, historically Boise is right around that 8% year over year mark. And so over a period of time, I think that that's a reasonable expectation for people. The benefit of owning real estate, as you alluded to, is that when that equity grows, you can leverage that equity, and you actually are buying that equity at a discount because you don't have to pay for the entire value of that up front.
Yeah. So if you put 3 or 5% down on a house, then you're able to house hack it. It grows 8% over 3 years. That 3% then becomes 25 or 30% equity. So let's say it's a $500,000 house. It goes from $15,000 to $125,000. That's a great return on a $15,000 investment over 3 or 4 years.
Absolutely.
And it's hard to beat. Honestly, those are better than hedge fund kind of numbers if you're able to work those. And so when you're buying it, even if it costs you a couple $100 a month to subsidize the rent, you're still much better off after 3 or 4 years. And rent goes up over time, and mortgage rates go down sometimes, and your monthly output pretty much stays the same or grows much slower than rent growth. So over time, every deal looks better and better, right?
Yeah. So this is a concept I kind of want to dive into a little bit. A lot of people would say that it's reckless to even throw out the idea that you might buy an investment property that you know is going to be cash flow negative. And I'm not saying that people should or should not do that. People just need to go into situations with their eyes wide open, understanding what they're getting into. But there's a caveat to that there are a lot of different ways to mitigate your risk and make money in real estate. And I have a little anecdote that I'm going to try to make short. I met with a guy locally who I hadn't met before about a year ago that was flipping properties. And I knew he was a flipper, kind of a quieter guy, and he was doing volume. I had no idea the volume of flipping that he was doing. He was doing a lot. I'm talking 40 to 50 houses a year.
It makes me tired just thinking about it.
So he had a couple crews of contractors that he was managing, and he was out.
Do I know this guy?
No.
Okay.
He was managing a handful of, he had real estate agents and people going out knocking on doors and trying to find deals for him. And he had a machine going and he was doing great. And everything about his operation was efficient. And the only thing that was inefficient, in my opinion, is that he wasn't keeping any properties. He was flipping everything. And I guess for the disclaimer, before I go into the story, as we've talked about, nobody on this podcast is a tax professional. So we're not giving you tax advice. You should talk to your CPA
to verify all information.
You should talk to a professional CPA. But so this guy,
he's paying 40%, 30% tax on every
so
dollar.
I sat down with him and we're kind of going over the numbers. And to be honest with you, there was, as an advisor or a real estate agent, there was no value I could bring to this guy. And I wasn't trying to do a deal with it. I hadn't met him and he was doing cool stuff. And so I wanted to talk to him about it. And so when he was telling me this, I said, well, tell me about your tax bill for the last year. And he was like, oh yeah, I think I wrote a $350,000 or $400,000 check to the IRS last year. Which
means he's made a lot of money.
He made a ton of money.
But it also means he spent a lot of money on taxes.
Absolutely. Yeah. And so I said, okay, well, you don't need any help finding deals. You don't need any help learning how to be more efficient. You don't need any help understanding the market. He had all that down. But I said, why are you not keeping any of these properties? And he said, well, I had several this year that I ran the numbers and, interest rates at the time for investment properties were 8.5% or 9%. And he said, every single one of them, even the best deals, I had a couple of them that were going to be $200 negative cash flow. And that just seemed stupid to me. Yeah, and so
I'm just thinking about the numbers going, that is not the right decision.
So, well, it was really interesting because he was open to having a conversation with me about this. And so I kind of talked with him about the tax breaks that he had. As somebody who was working full time in real estate, he was a real estate professional, and that opens people up to a lot of tax advantages that the general public does not have. And so, to shorten the story up here a little bit, had he kept, we'll just use one. We'll use an example, one rental that was negative $200 a month cash flow. That would have cost him $2,400 a year out of pocket, but also he would have had appreciation on that property over the course of a year. And so, if it's a $400,000 property, and let's say even conservatively, it appreciates at 5%, that's $20,000. So he would have paid
10x his money.
He would have paid $2,500 out of pocket on those month-to-month losses for a $20,000 gain in equity. But in addition to that, he could have done a cost segregation study on this rental property and accelerated depreciation. And that's a whole nother podcast. But the bottom line,
have a podcast about that, yeah.
The bottom line is he probably could have taken $80,000 to $120,000 off of his tax bill in 1 year by keeping one property and doing that.
Does it 3 times, he probably lowers his tax bill completely.
Right. Yeah. So, I literally had like a napkin there when we were doing back of the napkin math. And so I
did
said,
his jaw just drop?
Basically, well, it's really surprising to me that, I shouldn't say surprising. We all get into our specialties and our lanes and kind of get tunnel vision. But I was talking to him about, like, had he kept 4 of these properties, he could have completely wiped out his tax bill of $300,000 plus. And he chose not to do that because those 4 properties would have cost him $10,000 out of pocket.
Yeah.
So he traded a $10,000 paper loss for a literal $350,000 gain.
Yeah. And I'm thinking if he kept 4 of those projects, just 10% of them, just the savings on taxes for those 4 units, that the profit he makes from flipping them pays for itself.
Absolutely.
Like just 4 of them.
Yeah.
Oh man.
There's just so many ways that you can make money in real estate. And the reason I told that story is people are scared to get in, especially right now with interest rates being high and things not cash flowing. And again, I'm not saying that you should get into anything that you can't afford to do, or that if it doesn't go the way that you want, that it will cost you your lifestyle, or it will affect you in a negative way. That being said, there are people that are in a position where the tax benefits that they may have from buying a rental property would far outweigh any cash flow they would get in the first 2 to 3 years. And then after 2 to 3 years, that property will have stabilized itself and it would be cash flowing anyway.
Yeah. Yeah. Well, I love that. Thank you for sharing that story, because I think it kind of illuminates that it's not a single, easily double faceted, just equity growth or income. Like it's a combination of equity growth, income, value add, of tax savings. It's this holistic picture that's really complex. And once you kind of hone in on, there's lots of ways to make money, all of a sudden deals start popping up in different ways.
Yeah.
Right. You start seeing new
ways. A lot of people come into real estate investing and the only lever they're looking at is cash flow. And if they can't pull that lever, it's not a deal. And that's understandable. A lot of people are getting into real estate investing because they're trying to free themselves away from their day job. And so I understand that perspective, but the more you do and the deeper you get into it, the more levers you have. And there's a lot of creative, interesting ways that you can offset your tax liabilities, that you can create income, can create cash flow, create equity that may not be obvious just at the first glance.
All right. Well, this is the end of our first little series of 4 podcasts that we're doing. Anything you want to preview for maybe what's next, or stuff you want to talk about in the next series?
I actually love the idea of us bringing some local experts in here so that people can listen to other voices other than just me telling the same old stories.
I thought it was pretty good. Listen, you enjoy it? Okay. So we are going to be doing this. We have some Ask Me Anythings that will also be on the podcast that you can listen to hear more about people's questions about investing. We both love just connecting. So if you want to connect with Corby, what's your handle on Instagram?
At Boise Turnkey.
At Boise Turnkey?
Yep.
I'm at Bobby C. Frazier, Frazier. So please reach out. We love to talk. And let's do some deals and build some houses.
I love it.
All right. Take care.
See ya.